Hi, my name is Kirby Wells, and I'm here to talk to you about timing sensitivities in valuations. I am the managing partner of Wells Works, which just means that I started an LLC and I do some independent consulting work. I do partner up with folks that I'll mention in the presentation, and I've been on a bit of a sabbatical, which has been very nice. But given the level of work that I have through word of mouth, it'll be interesting to see what happens as I launch. A little bit about me. I went to school, studied physics with a minor in electrical engineering, which turned out to be helpful to get me into a master's engineering program at U of H in petroleum, and then went back years later to do some business studies at London Business School, courtesy of one of my employers. I've had a bunch of titles, but the thing about degrees and titles is that I had all of those before I had a whole lot of experience, with the exception of the business school. So I don't really see those as qualifications, and I'm going to talk to you a little bit about my career path to give you a better feel for what I can do and who I am. About me personally, I've got a kid at A&M, got a kid in high school, and a wife at NASA. You may meet her if you do a tour out there. Your kids will meet her if they do a school trip. And I have lots of hobbies. They are becoming increasingly important as my kids learn to drive and move on in their lives. So I'm finding that to be a rewarding transition. I like to build resto-mod cars, which is basically adding modern features and performance to old cars. You can see some of that behind me here. I enjoy backpacking with my friends. I'm really into the Smoky Mountains and the Ozarks lately, and that's been a lot of fun. And I enjoy live music. And the best concert we've been to lately was actually just a few days ago, where my wife got to see the Linda Lindas. One of the boys got to see Green Day. The other one got to see the Smashing Pumpkins. You can probably tell by their hair who's who. And I got to see Rancid, which is amazing. And I was really worried that I had missed my chance to see them. So it's a great show if you get a chance to go hit it. So let me tell you about my actual qualifications and my career. So I started in oil and gas in 2001 as a tech at Ryder Scott. And in that role, I learned how to run just about every evaluation software out there, including PHDwin, which was just kind of starting up at that point. So I was sort of a beta tester in a very early version of PHDwin, ran a lot of Excel, and went to school at night, did my master's, and then went to work for one of our clients. So Ryder Scott or D&M or any of those types of firms are a fantastic place to learn about our industry, because you see what all of those clients do every 6 months. And every time they raise RBL, do an acquisition, any of that kind of thing that requires an audit report. And so got to see a very wide view of the industry and understand how different people approach the business. And I wouldn't trade that time for anything. Once I got to work for our client, the COO had some great advice. And he said, look, there's never a good time to demote yourself out to the field once you get used to working in the office. So I had some coworkers there that helped me kind of demote myself to the field, which was a great opportunity. So I did some wrenching and I drove a truck for a while, worked my way back up to PHDwin as an asset manager and a reservoir engineer, and helped sell that company in 2006, which was another fantastic experience because auditors view the world very differently than brokers. And so going through that process and seeing how people think about the assets that we deal with every day was very, very interesting. And it's amazing how differently people think about the same things depending on their role. So it's always a good idea to get a feel for what people do every day and how they think about it when you present information or listen to them, communicate with them, so that you have a better understanding of what they're really saying. I went on to a small consulting firm in 2007. I think I interviewed on February 27th, and then March 2nd, I was in a tent in Tanzania. That was another great experience. Got to travel all over the world. Did a lot of work with bulge banks and national oil companies and independents all over Africa, South America, Middle East, and Europe. So I did a lot of Excel and PowerPoint for a while there. And my family, for various reasons, asked me to please come back to the States in 2010, which was a great decision to do that when they asked me to. Always make sure you got the right balance there. So I came back to PHDwin and PowerPoint as a portfolio manager for Enervest, which kind of morphed into an asset manager role as we made some acquisitions. We got very good at evaluating AFEs, evaluating operators, and making investment decisions that then allowed us to look at assets and plays through a non-op window and make some excellent acquisition decisions to get into those assets. And as part of that, we had to do a lot of acquisitions and some divestitures. And so I was asked to help with those in the role of kind of coordinating the due diligence, which is something we'll talk about in a minute. And that was another expansion in my experience. So at the time, I was managing the engineering, geology, land, and some accounting and support roles, as well as the field operations for a very large asset. And then I got to go in and do this due diligence, which brought in legal and a lot of other functions that I just wasn't as familiar with, a lot of finance and legal. So that expanded my horizons again, and it was great. I really enjoyed it, and so I've kind of focused on that realm since then. I've done some work with private equity-backed companies and other firms. Had my first board position in 2019 with Ineos O&P USA as they were getting into the onshore business in the U.S. And then between 11 and 23, I've been to many data rooms. I've been involved in about $4 billion in acquisitions that ultimately closed, and then performed due diligence on those acquisitions in most cases. So there are people out there who have seen many more transactions than I have, but there are very few people who've seen the breadth and depth of what goes on with an acquisition that I have, and very, very few people who've done both. And that's, I feel, my best qualification for doing what I do. And now my career has come full circle, and here I am presenting at PHDwin Week in 2024. So in a nutshell, I went from Excel to pickups to tents to PowerPoint to boardrooms to PHDwin. A little bit about Wells Works. I'm focused on buy-side services, as I said. So I like to be involved in the acquisitions. There's acquisition due diligence, which is an incredibly complex undertaking that happens in parallel with a lot of other critical planning. And so that is kind of the time frame where I like to come into things. I do some data room support and some valuation support, more advisory, because the teams that are leading these acquisitions, they have a relationship with their investors, they have a mandate, they have a plan and metrics, and my job is to come in and support them in their goals, not to tell them what their goals should be. And so people just don't welcome, and a good team doesn't really need that much help at that stage of the process. Where they need support is in the transition planning and the acquisition due diligence, and especially in the capital program due diligence, because at some point they are the dog that caught the car, and when you're keeping up with that bumper, it's a little late to be doing everything, but that's the nature of the business, because you don't want to fully staff and fully resource an organization before you have an asset to run it. So it's a bit of a catch-22 that they're in. I understand the process very, very well, and that's what I like to support people in doing, primarily in a project management role. So helping them define deadlines and deliverables, track their critical paths, and integrate all these disciplines and consultants that they're typically working with at that phase, because there are so many competing interests that it's easy to lose your own in trying to put together all these deliverables on a short time frame. So one of my favorite quotes in that regard is that to achieve great things, two things are needed: a plan and not quite enough time. And that's from Leonard Bernstein, who knew a lot about taking a large group of people who were experts in their field, but had very different skill sets, and bringing them together to create an exquisite piece of work. And that's very much what goes on during acquisition due diligence. So I've always liked that quote because we find that we always have the not quite enough time. We usually have a plan, but plans always need to be in progress, and we don't always have the right team and resources. So that's where I like to come in and help out. So some lessons that I've learned from these acquisitions. Collaboration is a great indicator of the stakes. When you find yourself involved with something where people are not behaving professionally or not serious about it, that's a great indicator that the stakes are very small. When you're working on a large acquisition, on something that's critical to people's careers and critical to their reputation, where there are all these fees and bonuses and careers at stake, people tend to get very collaborative and very serious. They communicate clearly. They tend to be more forthright, and there's just not a lot of shenanigans. So if you find yourself in a situation where people are behaving that way, it's a great indicator that the stakes are high, and that you're involved in a project that many people want to succeed, which is always a great experience. Always work backwards from your deadlines. It seems pretty clear, but again, you have not quite enough time. And so if you don't work backwards, then you won't have a plan to beat those deadlines. Do rigorous work once. So when you download a data room, oftentimes it's in the PSA and it's in other agreements that once you download something, that's been disclosed. You have it and you're responsible for knowing it. So read what you download. Go through the information that's provided in a rigorous manner. And when you find yourself creating a table or tabulating data or referencing something the first time, go ahead and summarize that. Table out the number of wells in each field. Land on your metrics, your production, your volumes, your net present values. Land on all those things. Nail them down and share them with the team, and then store them in a place where everyone can find them, so that you have consistent references going forward and you're not repeating the same work over and over again. Quantify and summarize issues. So this one is really important. When you raise an issue, when you walk into the room and say, hey, there's this thing that we got to look at, and could be huge, could maybe not be huge, I don't know. In that instant, it is the most salient issue on everybody's mind. And so it's very easy to hijack resources and emotional energy with those types of statements. It's always good to say, I see something that I don't yet understand. I'm quantifying it, and I will issue a report this afternoon. But you don't want to speculate on how important or critical something could be without the ability or the effort to quantify it. If it's something you can't quantify, then involve the right people to quantify it. But you don't want to raise kind of nebulous, oh my gosh, could be the end of the world type concerns that turn out not to be major concerns, because people are prioritizing and managing their efforts very closely during an acquisition. And then lastly, as we enter an age where people are more and more working from the same data set, those data sets are accompanied by much more advice and more digested inferences and information associated with those data sets. There is less variety in the range of valuations that people come up with. And so expertise and experience are much more valuable in translating a data set toward a specific asset or a specific team at a specific time. And it's always good to bear in mind that when everybody knows what it costs per foot to drill and complete a well in a given basin, the person who knows the most about what it's going to cost your specific team to drill and complete your specific wells is going to have the biggest advantage in forecasting the results in that play. So let's talk about acquisitions in general and kind of the general timeline that they follow. And I'm going to try to communicate a sense of how it works, not just in the timeline, but also in the complexity. So you always have an effective date, which is the date at which the owner will take on the benefit of the cash flow or the expense from that asset. So it's as if they had owned it starting at that date, but then you have a closing date that's later, and that allows you to account for things very specifically and come up with your closing statement. You'll have a data room in which typically a broker will share information with you. That information is often, I don't want to say adulterated, but it's been changed to market the asset. And so you'll see certain repeating themes in those data sets, and that's a skill set all on its own. At some point, you'll submit a bid, and if you're the winning bidder, then you'll negotiate a PSA. There's typically a form PSA that accompanies the bid, and then you'll negotiate the specifics once you're the winning bidder. And that triggers a period of time where you perform due diligence and then notify the other party of any defects that you find in that due diligence. There's a closing statement that says precisely how much all the parties owe, and then you'll close on the asset. And then there's a time after the closing typically where you'll do a little bit of curative. You'll get the opportunity to correct some of those defects rather than just change the acquisition amount. You may have a transition period where the seller continues to operate the assets on the buyer's behalf, and then you'll have some closing adjustments. And so each of these boxes, each of these steps in the process involves many different disciplines and many different tasks and deliverables. So acquisition due diligence, for instance, is often kind of a bank and financing driven process that also serves to uncover any defects, and it's kind of your final opportunity to figure out if you are actually purchasing what was represented. And so there's a lot that goes into that. At the same time, your operations group is going to be doing their operations planning. They're going to be finalizing a budget. They may be supporting procurement and negotiating MSAs. They're going to be ensuring that you have the rigs and spreads that you need, checking field inventory, ordering signs, because at some point they're going to have to put signs out in the field with your name on them. And that's always a process that takes a while. In parallel with that, your marketing group is going to be trying to nail down stock in tanks. They're going to be looking at imbalances and hedging, things that can affect the closing. They're going to be looking at credit agreements and bonds. So it's remarkable how difficult it is to get people to buy your products. And so there's a lot of credit agreements that go into that. And then they'll be reviewing all of your contracts, negotiating things, helping with your development planning to make sure that you're not curtailed, that you can actually deliver the volumes that you say you want to produce in the future. In parallel with that, finance is working on how you're going to pay for all this. You've got accounting figuring out exactly how much you need to pay, how they're going to transfer all of this data in from the seller, how they're going to get it into their own systems, how they're going to set up their decks and their jibs. They're going to have to manage AR and AP from day one. They've got to calculate those purchase price adjustments. They're going to need to set up work orders to launch your development program, and pro forma financials that change frequently as you learn more and more about the asset, manage that budgeting process. So they need to be in the loop on everything. Then your land group is going to be checking all of your title. They're going to be out there doing your field visits. They're going to be talking to brokers and attorneys to make sure that you are actually buying what you think you're buying, that the seller owns it. It turns out there are many more sellers than owners and many more shoppers than buyers. So the land group is instrumental in that process. And then they're working on a lot of curative. So they have a tremendous amount of work to get done at closing. Your reservoir engineers and your geologists are confirming that they understand exactly what's in the ground. It helps to have a team that's already familiar with an asset. Your procurement group is working on hundreds of contracts. So I'm always amazed how many times people hire in to manage a process, and it's always just kind of been there. They've always had the software, they've always had the people to work with, and when your procurement group is not set up yet and you're a startup company, that's just not the case. So they're doing a lot of credit reviews, a lot of vendor selection. They're looking at certificates of insurance. They have a tremendous amount of work to do, but nothing gets done until those MSAs are in place as credit agreements. You've got human resources who's scrambling to hire the right people and bring them in. And so they're negotiating and interviewing, and you've got things that need to get done by people who are not in-house yet. You have your safety group out there reviewing the field, developing policies and procedures, making sure that you can operate safely and forecasting your performance there. IT and security are helping you get all your software in place. You've got to get new badges for people, even if you buy the field office. There's just a lot that goes on there. Your regulatory group is making sure that you've signed and agreed to everything that the regulators need for you to come in and operate the asset. Otherwise, you'll be out of compliance, and that's never a good thing. And all of this is managed by the leadership team, who may or may not be in the process of actually developing a full org chart based on this specific asset. They've got to set up delegations of authority so that they don't have to approve everything directly, but there's still plenty of stuff they have to approve directly. They're setting up policies and procedures. That's a lot of the value that comes in with a management team, is that they have these networks of policies and procedures that people need so that they know how to get their job done when they walk in on day one, or they can develop that. Because the first question can't be how do we do that when you have a startup. The question needs to be how should we do that, and then put that in place. And then there are so many signatures, so many things they have to do. So if the management team is all of those people, then you can see they get spread very thin very quickly, and so there's just a lot to do. If the management team is not all of those people, even if it's a large established organization, then there are many departments that you've got to coordinate and make sure that people are communicating with each other quickly and clearly, that people are delivering what they asked for and what they need, rather than what people thought they needed. And there are so many things that happen in those interdisciplinary discussions that just require familiarity with that process. So many times where marketing will ask for a report from accounting, and they'll get it at the last minute, and it's not the report that they needed. Very often, legal will review contracts for people, and they'll come back with red lines as opposed to an explanation of how the contract works. And so there's just a lot to manage there, and there's plenty for somebody to do that can come in and help with those processes, and that's what I try to do at the end of the day. So let's talk about this exercise that we're going to talk about today. So what I want to do is set up an acquisition, and then we'll talk about the story of the acquisition, how we got to where we are, and the timeline. And then we're going to look at where we are on our capital program planning. And we're going to look at a few scenarios that have different timing sensitivities. And I've tried to keep everything as static as possible so that we can look at just the effect of timing. And I don't mean the discounted value of money, although that is important. I mean other factors of timing. So what we're going to be looking at is an acquisition where we've already negotiated the PSA, we've been awarded the acquisition, and we've already performed much of our acquisition due diligence, and we're getting in there and working on our capital program planning, primarily with the operations and marketing teams, which is not something that a lot of people may have done. And then there will be a little bit of PHDwin how-to, but not a lot of that. So let's talk about codename Springfield, which is what we're calling this acquisition. So for now, again, we're going to focus on timing and related sensitivities, and again, there's just very little PHDwin how-to involved in this. So how did this acquisition start? Like where was it? At some point, everything started. So the original operator leased this asset in 2015. They drilled 30 wells in 2016 and 17, and in the data room we refer to those as the Gen 1 wells. The seller purchased this asset in 2018. They went to get started with their drilling program, and COVID hit, so they waited out COVID. They drilled 48 wells in 21 and 22 when prices were very high, and so they had some ideas to outperform those wells. They drilled 8 wells in 2023. There were longer laterals, had bigger fracs, all the things that you hear about in data rooms. So every well drilled in the future is going to significantly outperform every well that's ever been drilled, and it's going to come in much less expensive. So in the middle of that process, they decided to sell because they have another asset where that money can be invested much more efficiently, and they hate to let it go, but they're going to sell this asset. So their plan in late 2023 was to sell this asset effective April 1st, so they could announce in Q2. They wanted to have a closing in June 1st so that they could announce the deal was closed when they mentioned it to their investors. They wanted to launch a 3-rig program on October 1st because they have a full leasing team that's out there leasing acreage. They have a full procurement team that's buying casing and staying ahead of this rig that's running. And they have a D&C group that's staying on top of their rigs and spreads and all the planning. They have marketing professionals that are making sure that the pipeline will be ready to take their gas. They have all that in place, and so this is going to be very easy for the seller or buyer to just step in and take over the asset. So I want to point out nothing in this example is specific to any transaction. So if you've worked with me on a transaction or you've seen me around in the halls or something, just know that I've encountered all of these situations in some transaction. Some of them not in exaggerated form, but I have seen all of them happen. I haven't encountered all of these in any single transaction because that would just be too much. And something stands out in every transaction. So never expect a transaction to just go perfectly smooth, but please don't try to look at anything that we see today and guess which one I'm talking about, because it's really nothing that I'm talking about. So how was it going when we went to the data room? So now it's 7/1/2024, the date that the seller wanted to close. The broker is right now hosting data room visits, and they want bids by 7/20. So we've downloaded all this information from the data room. The closing date has moved to October 1st, when we were going to start our drilling program. So the broker acknowledges that we now need to move the start of drilling to November 1st. But in the meantime, the word's gotten out at the seller that they are selling. Their land group is not quite as large as it used to be. Their drilling group is not as large as it used to be. They're not spending as much money on casing and long lead items like facilities. They're not negotiating with their gatherer to get pipes in place because they want to leave all that to the seller. They want to leave the benefit of that to the seller, and they don't want to spend a bunch of money during a time where they want to talk about increased cash flows. So some of that long lead planning has slowed down, and we now have about 4 months to get ready to launch our drilling program. So how is it going at the valuation? Right. So this is October 1st. We've done our valuation. We've submitted our bid. We've been awarded the bid. And now we have some second round negotiations that have gone on. The bid valuation assumes that we launch 2 rigs on December 1st and another one on February 1st. Right. So the management team, when they were doing the bid, recognized that November 1st is pretty tight. But they have friends that are very high up at drilling and completion companies, and they're going to be able to get a rig and a spread and get out there and get this done. So the bid valuation is the basis for our preliminary budget at this point, and we've gone and presented to our investors before we made that bid what we think the asset is going to look like. So how is it going on September 13th, 2024? We're wrapping up the acquisition due diligence. We have a close on 10/1. So probably early next week, we're going to have our defect notice date, where we have to tell the seller how much money we expect to take off of or add to the purchase price as a result of issues that we've uncovered in compliance with the PSA during our acquisition due diligence process. And we brought in some experts while we're waiting on HR to hire our team. We brought in some experts that have really dug in and done a lot of detailed analysis of our drilling program and read all of our contracts and gotten into our marketing and our legal and all these different facets of the acquisition that we probably didn't have the opportunity to dig into in great detail before the bid. And our drilling experts now advise that they could do better if they had a long-term rig and spread contracts. Then they could get much better rates if we wanted to start in April of 25. And marketing advises that they found some contracts that may not tie to the model. They're working to quantify that with our analysts. They're going to get back to us shortly on what they find. So what we know right now is that somebody might want to start drilling and launch a rig around April 1st. They might want to launch a second rig around June 1st and a third around July 1st. And that's been floated as a proposal, not a proposal that I would float, but we'll look at that in a minute. So let's talk about the database, because we are doing this in PHDwin. I built this database out in 3.1.17. I use projects to model these fictitious drilling campaigns that I talked about in 16, 21, and 23. And what that effectively did for me was create a PDP wedge when I applied my 4/1/24 effective date. And this is the wedge that I get. That's our PDP wedge, and it's going to be the same for all of our different scenarios. I did not bother creating projects. I used the project tool to schedule the wells, but I didn't create projects for those wells because I didn't plan to move the PDP around. I did create projects for my undeveloped wells, and I created them at the rig level so that I could very easily schedule those projects, move those project start dates, and shift all the associated well start dates with when a rig is going to start. I generally made the assumption that the rigs will drill a well every 30 days, which is pretty conservative. And I generally made the assumption that the first rig will start on the 1st, the second one will start on the 11th, third one will start on the 21st, just so that we have a little bit of a stagger in our wells coming on. But again, this isn't tied to any actual field or forecasts. So you won't find a well that looks like this forecast, and you won't find a field where you can only drill a well every 30 days at this point. So let's look at some cash flows and plots. And then we're going to go back and look at these scenarios that we've talked about and set up. So we started with the data room, and the seller had a forecast in the data room. In practice, sellers don't really do this where it's broken out by class. So in a typical data room, you'll have developed producing wells and you'll have undeveloped wells. And sellers, brokers in particular, tend to be very conscientious about putting all of that together and not limiting you with classifications. So one of the first things that you'll have to do in a data room typically is to go in and figure out how you want to classify all of these locations, which ones you want to prioritize, which ones you might not want to spend a lot of time on, and try to kind of whittle that back and get it into a format that you're comfortable with so that you can find the full value and represent your risk tolerance. So it's unusual that you would have a PDP and PUD forecast, but we're just going to pretend that we got this very clean result after we kind of parsed our data room view, and that's what we're going to call the data room. I've used a GOR of 2 MCF per barrel, so you'll note that the oil and gas forecasts follow each other. I've used a pretty consistent water forecast, and so we can just focus on the gas if we want to get a feel for how things are producing. And I've manipulated this to the point where it's not representative of any field I've ever seen, because it turns out it's pretty difficult to just invent a fictitious field that has reasonable economics and kind of moves around in an intuitive way. And I think that's part of the reason that so much more fiction is written in Excel than in Word. So our timeline is there at the bottom left. And what we're looking at is our effective date of April 1st, our closing of October 1st, and launching our 3-rig program November 1st. Because again, timing sensitivities, and that's what we thought at the time. So this is what we were looking at in the data room when we started off. So at this point, where we are now on September 13th, the data room forecast is kind of an archive snapshot. There was a time when we were concerned with how our bid valuation compared to the data room, because it was very much in our minds what the value of this asset may be to the seller and to other buyers. At this point, we're much more focused on our bid valuation, because that's what we presented to our investors, and that's kind of our plan going forward. And again, it's classified as proved, so that's not something you'd normally see in a data room. Just the character of this forecast is that it peaks at about 2.6 BCF per month in 2027. You have a rapid increase in production starting in late 24, which means you're going to have some capital in 24. And then you have kind of a nice steady decline after that, after you drill these 120 locations. So the PDP will not change. And as we shift the undeveloped around in time, it's good to just kind of have a feel for the shape of that profile and how it moves around in time and where it peaks. So the story coming out of the data room, and this is something very important to understand, because it's easy for the analyst to get caught up in the software and outputs and focus on kind of comparing runs to each other based on NPV and volumes. It's easy for the marketing expert to focus on maximum production rates. It's easy for reservoir to focus on the type curves and focus on the volumes. It's easy for accounting to focus on the totals sometimes, or on annual totals. But your management team is very much focused on what they're going to have to present and the story they're going to have to tell their investors, whether it's a public company or private, on a monthly basis, right? And so it's the shape of the profile and the story that really drive important decisions at this point in the process. And it's important to kind of be well versed in how those are perceived, so that you understand what people will hear when you say certain things. So at the time that we visited the data room, management went in and said, hey, it's worth working up a bid. We think we can meet our 5-year payout goal. I know 4 would be better, but we can get a 5-year payout. It's about $1 billion transaction, which is about the size that we were looking for. There's going to be an additional $85 million needed in 2025. So we don't have positive cash flow until 26, and we don't really start making money until 27, 28. But we're going to have $30 million on the books the day that we close, because remember, the buyer is going to have the benefit of all the operations from April 1st up until the closing of October 1st. And so they're going to have $30 million in the bank based on the PDP assets. We've got these undeveloped locations ready to go. We've been talking to the banks. We can get an RBL in there. And so we think we can, we're not going to have to bring all this cash to close. We can delay a little bit of the capital cost. This 5-year payout's attractive. And we did this, of course, at our $70 oil, $3 gas flat projection. There's always a lot of debate and a lot of discussion about price forecasts. The right answer is what the executive team wants to look at and how they feel about it. Gas was $2 or $3 when I started my career. It might be $2 or $3 when I finish. But if someone knows that it's going to be $8 or $1.05 next month, we absolutely need to capture that in the forecast. So when it comes to price forecasts, unless your job is to develop the price forecast, and there are lots of ways to do that, and I've got my own preferences, Sometimes that's one where it's better to be smart than right, because everyone's going to have a view, but implementing what management wants to see will help them get the cleanest view into it, the way that they want to look at it. So I haven't done any escalation. I don't have a very complex pricing scheme, but price is typically one of your biggest sensitivities, if not the biggest. So it's important to make sure everybody's on board with that, and that you always discuss it and present it when you talk about this type of information, so that people understand what the price impact is. So we went to the data room, and then we did our bid. And you might recall we made a couple of changes when we did the bid. So this is the case that we built that supported our bid for the asset. And this, again, is what we're going to tie back to going forward, because it's of limited value to look at what the seller presented, or what our cleaned up version of what the seller presented was, compared to what we arrive at in the future. What we want to tie back to is the story that we told our investors in order to get the right to bid on this asset. So any changes that we make will need to be tied back, and it's important to track those. So again, always label your information, your runs, with a date, so that you can rebuild these stories over time. So we delayed our volumes a little bit from the November start to a December start, which reduced some of our 2024 volumes. We still have a little bit of capital in 24, but we're still peak at about 2.6 BCF a month in 2027. So didn't change our profile too materially. We'll have a little bit of discounting impact, but not much. Let's look and see what that does to our story. What should we expect to see as a result of that change? So the delayed drilling will shift our positive cash flow from 2026 into 2027, but we're just barely negative in 2026. So barely negative is basically nil, which is basically where we were before. And that's not, may not cause any huge issues, because we're still looking at about a 5-year payback, 5 and 5.5, start with the same number. So the delay does push our payout back a little bit. And we're going to need an additional 105 million now in 2025 instead of the 85 that we thought we were going to need, which is a material change. We now see positive cash flow in 2027. We think we can support an RBL of $240 million based on our PDP and some preliminary discussions with the bank. That's going to drive a lot of our due diligence, because that RBL is going to define what percentage of the value we need to perform our title due diligence on. And it's also going to drive the way that we model the asset, so that we can go in and present it clearly and support the bankers that are helping us in our technical presentations. And so that RBL really drives the business and drives the acquisition quite a bit. And I always caution people to be careful. Even though the RBL is in your best interest and the bankers are working in your best interest, a good RBL package doesn't necessarily guarantee that you've done all the work that you want to do, specifically and particularly around capital planning and your transition planning. So always make sure that you focus on that adequately. We still have 120 undeveloped locations to go, still the same price strip. And again, this is the story that we told our investors before we bid. And so this was not a surprise to anybody. It's just a little bit different than what we thought we might look at when we went in and prepared our bid. So we recommended a bid of $980 million, and it turns out that's going to be successful. There's $710 million cash at close, because again, we have now some revenue from prior operations. We have some discussions with our banks about RBL, and now we have a better feel for how much money we're going to need to bring in later. So some of that $105 million in 2025 is capital that we're not spending in 24. So that's nice. That's a little bit of an offset. And then we're going to need another $18 million in 2026. So at the time of the bid, when the CFO and CEO and others go in and talk to investors about making this winning bid of $980 million, the expectation is that we're going to buy this asset. We're going to get off to a great start in 2024. We're going to spend all this money as a lucrative investment in 25. 26 is going to be close, but there are lots of things we can do to try to turn that positive. So that's going to be our focus. And then 27, everybody's happy. We're well within cash flow, and we all have a great year in 2028. So that's the plan that we're working toward. That's the story of the bid. So here we are on September 13th, 2024. So now we want to bring things current. We've done some of our acquisition due diligence. We've gone through this acquisition in great detail. And of course, I know you guys want to hear about this MVC that I keep bringing up, the MVC. So, okay, so not everybody caught the MVC. It was disclosed in the data room. You might recall when we were on this slide. It's right there. There's that footnote was there. You can go back and check the tape. There's a $2 million impact from MVC agreements in 2025. So that's something that we need to understand and confirm, which is something our marketing expert can help us with. And our marketing expert, as part of that process, was reviewing contracts, and they found some contracts that may not tie to the model. They're working with people to quantify that. So remember, they brought that up. Well, today's the day where they come back and say, here's what I found out about the MVC in the Springfield asset. So that's going to be our first kind of brick that we throw into the middle of this thing in order to look at timing sensitivities. So let's talk about the Springfield MVC. So an MVC is a minimum volume commitment. It's basically a way of guaranteeing payment for a gathering system, right? And other facilities and services that hit the midstream. So the seller or the prior owner, they needed to increase gathering capacity. They're drilling all these wells. They need to build out a system that the gas goes into. That's not their expertise. It's not what they want to manage. Or they did build out a system and they'd like to sell that to someone else and capture some of that capital. So they need to pay the gatherer back for operating and building that system and investing their money into it. The gatherer says that they need $325 million to pay for this expansion with interest, and they want to get their money back in 4 to 5 years. Okay. Now this may have been renegotiated at some point. We don't know. But in the most recent negotiation, what happened was the seller and the gatherer got together, and the seller proposed an expected throughput. And they said, we believe that this is the total volume of gas we're going to deliver to your system, and we want you to guarantee to us that you'll be able to take that volume of gas at these times. And the gatherer said, thank you very much. We're going to charge you this amount of money for all of that gas that we collect. And if we have a little bit of spare capacity, then we're going to charge you some lower rate for that capacity. But that guarantees we get at least $325 million in our 4 to 5 years. So for our example, the data room database models this MVC as a weight average gathering and transportation expense. Okay, so it is a gathering and transportation expense, and it's also a very simplified MVC though. So this one has no tranches. There's just one limit that we have to hit. There's no additional limit where the seller may be paying a slight premium to have guaranteed capacity or anything like that. It's a fixed fee. The MVC price does not change over time. Sometimes it does because there's nothing that drives ingenuity like debt structuring. There are monthly volumes, which is nice. Oftentimes you'll see them scheduled quarterly or on some other basis, and that can be tricky. There's no escalation in the price, which would not be a major hurdle, but it does make it difficult to kind of back calculate and verify our numbers. And there's only one system. So oftentimes you'll have multiple gathering systems that may go into different pipelines or through different processing facilities, and each of those may have its own MVC, and it can get rather messy. So what did the seller think was going to flow through this? And here we are with our data room forecast. Now, this kind of thing doesn't happen very often, but when it does, it's fantastic, because what this tells us is that we have gone into the seller's database and we have done our own view of that, create our own view of it, and very quickly come up with something that we can believe approximates what the seller thought they were going to do. But again, it was done in Excel and I did it, so I just backed into it. But you don't always have that luxury. You don't ever have that luxury unless you're a midstream company negotiating an MVC. So it's a nice confirmation, and it shows the logic behind these volumes, but it's not something that you can often come up with. So let's talk about the algorithm for this specific Springfield MVC. So in this case, we have to deliver 66.375 BCF. That's the total volume under that purple MVC curve. And we have to pay $325 million. And so we've negotiated an MVC fee of $4.90, right? And that $325 million already includes their interest. And so we know that that's the right number. Again, I made up the right number. So in this case, we can assume a fee of $1.75 for any gas in excess of the MVC, or that we deliver after the term of the MVC. Okay? So what that means is we total our wet wellhead gas, all the gas that we deliver into the gathering system, right? We subtract the MVC volume from that total production. Okay? If the total gas is greater than the MVC volume, that is, we have a positive remainder, then we apply a fee of $4.90 to the full MVC volume, and we apply a fee of $1.75 to that excess gas, right? Anything above that MVC volume. And I'll show you a picture here in a minute that makes it more clear. If the total gas production is less than the MVC, so that is our total production minus the MVC gives us a negative remainder, then we're going to apply a $4.90 fee to the full production gas volume, right? And we're also going to multiply that shortfall by $4.90. So we're basically going to charge $4.90 against the MVC volume, not the volume that we deliver. So if we fail to deliver the volume under the minimum volume commitment, right, which is what it stands for, then we haven't met our commitment and we have to pay for it anyway. And then later, we have to pay to actually transport that gas when we produce it. So when you underperform your MVC, you still have to pay the full MVC amount. That's how it becomes a guarantee for the gatherer that they're going to get all their money back. So a few notes on MVCs in general. No one can sell their gas if it's not gathered, right? So most leases, many leases, it depends on the vintage and where you're at, but a lot of leases require all the NRI owners, scratch that. What they do is they allow operators to charge all of the NRI operators for their share of the gathering and transportation expense, right? And the argument again is that it's not going to get to market unless it's gathered, and so everybody owns that expense. So we calculate MVCs typically on the NRI, not on the working interest. But that can be on a case-by-case basis, because again, if you have a lease agreement that excludes gathering and transportation, you've got to make sure that you're carrying that expense somehow. You're obligated to pay the full MVC amount. Again, it's a guaranteed minimum payment in a way of speaking. So whether you deliver any gas or not, you still have to pay the full amount. So you want to deliver as much gas as you can, and under no circumstance would you ever shut a well in because the MVC gathering and transportation fees drive it negative. You're going to produce that well at a loss so that you at least get the benefit of the gathering and transportation fees that you're paying, and you come as close as you can to meeting the full fee. We don't have to estimate what these fees are or what the amount is. It's all tabulated in the contract, and we're working with a dedicated marketing professional, so we know exactly how much we're going to have to pay, and we know exactly what the contract specifies we have to deliver. So there's a lot of certainty there, and so at some point you'll want to risk these MVC fees appropriately. There are many different ways to look at it, but one thing that you can do is put all of the MVC fees on your PDP because there's no uncertainty as to whether you're going to pay this or not. It's a contract. If you put MVC fees on your undeveloped and then you risk your undeveloped at a heavier discounting rate, then you risk not accurately representing expenses that you're going to have to pay or the impact of those expenses that you're going to have to pay against volumes that you don't necessarily have to produce. So you always want to be very careful about how you model these things and how you allocate them. And you always want to work with your management team and with the banks to make sure everybody understands where they're landing. And then the other aspect is that PUD volumes are still delivered, so they can bear the MVC cost if you want them to. You just don't want to put shortfall penalties on them necessarily if you do that, because those shortfall penalties are a certainty. So it's up to you how you want to allocate things. I've taken a very conservative approach in this example, and it's one that I feel is valuable for looking at as a management team. But it's certainly open to discussion if there's another way to present it, and there are benefits to looking at it a little bit differently when you're presenting your plan. You need to have confidence in your plan. And then the other thing is, it's not just gathering and transportation when you have an MVC, because the schedule is fixed in time. So it's very, very common, because these can be complex, to see people pick a production forecast, table those volumes against the MVC, calculate the total gathering and transportation, and then allocate that back to the wells as a variable gathering and transportation expense, right? Which can capture the expense. It can work, but it doesn't force you to honor the MVC, and it doesn't shift properly in time when you change your forecast. So it can expose you to some uncertainties, as we're going to see here. Also, it's not just a financial instrument, right? There may be an option to buy it out, but we're not just going to look at buying it out. And if we did, that could create a lot of difficulties or a lot of challenges in dealing with your lease owners, or you could take on expenses that your lease owners would otherwise have to bear. And so you want to make certain that you understand all these lease terms so that you're properly applying either a working interest or an NRI and some mix of those. So here we are with our obligatory PHDwin how-to. So I'm gonna talk you through how I set up this MVC in PHDwin. I defined MVC gas as a product, so that's a specific product apart from total gas production. I scheduled that MVC gas in accordance with the MVC contract, created some incremental cases to pull PDP volumes into the PUD, created some allocation gel units to allocate those costs back to the PUD and PDP cases based on gas volume, or failing that, well count. And then I called PHDwin support and asked for Josh Neese because it was time to do some fiscal regimes. And we used fiscal regimes to calculate these fees and penalties and the total gathering and transportation, and then we use the gel units to put them back onto the wells. So that's kind of the process that we went through. One thing that we learned is when you build these fiscal regimes, you've got to go back and put them under the state tax regime. Otherwise, you can only use one or the other. So we have a child fiscal regime that essentially calculates the allocation factor that determines how much of this gathering and transportation each case gets. We have a parent fiscal regime that applies these fees back to those cases, and then we have some logic built into that. So what we chose to do was to apply the MVC fees back to the PDP, and then apply any excess gas at a rate of $1.75 or anything after the MVC at a rate of $1.75 to the wells that produce that gas. So it effectively becomes a variable gathering and transportation cost after the term of the MVC contract. And then we have some other fiscal regimes that we used to calculate intermediate results. And we also use static variables to define some of those things. So now let's get back to the numbers. and see how this MVC impacts our valuation bid in our case. So looking at our bid, this time with the MVC, we have our $2 million shortfall when we calculate these volumes. So here we are in 2024 and 5, and our total production is less than the MVC volume, which triggers a penalty equal to $2 million. So that's great news. We've now confirmed that little footnote that we had there. And so we know that we calculated that properly. Our volumes don't change because we just shifted them in time a little bit. But our valuation changes significantly because, again, we've now allocated all of these MVC charges back to our PDP as a risking exercise. And so our total valuation only changes by $4.5 million, but our PDP changes by $84 million compared to our bid valuation. So we now have a larger percentage of our bid on the undeveloped, and that changes the story quite a bit because that can impact our RBL. So here's what it looks like with the MVC. And you can see that we've corrected the model now to capture the MVC. We've delayed drilling to allow time for planning and redesign. That delay pushes our payback out to 5.5 years, still the same payback. We still need the same $105 million in 2025, but now we need more cash at close potentially because we need to understand that we may be able to raise less than the RBL. And unfortunately, in this example, or fortunately, depending on how you look at it, the delay in capital actually offsets the RBL, and so we still need $710 million at close. So not a large adjustment that our management team has to go back and tell a new story for, but it does impact their planning. We're still negative in 2026, slightly positive in 2027. Not a big change in the story, but it shows that we've applied some rigor and we have more precision. So let's look at one more example just to make things interesting. We'll look at the numbers on that. And this is kind of exaggerated, but it is something that happens. So remember, the drilling expert had said that, hey, we could get you a better deal if we launch that rig in April, right? Which is a huge ask. And we would expect to see some time value of money impact there. But now we have this MVC. Now, if the MVC were still scheduled as a variable gas expense under gathering and transportation, then we wouldn't see much of an impact. We would just see the shift in the time value of money and discounting. But now that we've properly scheduled our MVC, you can see that we have $73 million in penalties that now hit our asset because we are under delivering to those MVC volumes, right? So now we have to pay penalties on 14.8 BCF of gas that we wouldn't be producing if we went with this plan, right? And so that is a material change. Now the PDP valuation remains unchanged, and remember, we did that as a risking exercise. We applied all the MVC costs to the PDP. So this is a good confirmation of that because the PDP has the lowest risk associated with it. So when we make this timing change and it impacts our economics, we don't want it to have a big shift in our PDP valuation. We want to show that we're not hinging all of our bets on the undeveloped. So our PDP remains the same. Our undeveloped now has to bear additional transportation costs in the future for volumes that are delivered after the end of the MVC, but were already paid for as penalties, so to speak. So it's a bit of a double dip, right? We have these undelivered volumes where we've already paid gathering and transportation, and then we have future delivered volumes where we have to pay gathering and transportation at a lower rate. So the net impact of that is a significant reduction in where we would have valued this asset if we shift that development plan this far into the future. So for me, that would be kind of a non-starter, and I would want to work that really hard before I took it to management. But let's say we take it to management and say, hey, we'd like to just go ahead and make this change. We just need a few more months to get it lined up. And don't worry, we're going to save a bunch of money on D&C cost potentially because we're going to negotiate a really good rig rate. So this is a significant delay in our spud, right? which causes a significant delay to our payout. We're no longer at about 5 years, we're at a solid 6-year payout now, right? Which is a longer time, and it's not as compelling for investors, right? We now have to make up for $75 million somewhere in our valuation. Not that we're second guessing our valuation at this point. It is what it was when we went in and did the bid, but we also need a plan and a budget that presents what we're going to do in the future, and it has to tie back to that bid valuation. So the value of the exercise is in understanding the change and how what we need to do to drive us back toward the expected result or better, not so much in second guessing whether we should have bid this much or that much. We have an additional $217 million that we have to raise in 25 through 27 because now we're paying these MVC penalties. We're not starting our drilling as early. We have a much lower peak in our gas production, and we shifted those volumes forward. So the team that thought that they were going to have a lot of excitement behind them in 25, and then they're going to need a little bit more money in 26, but don't worry, we're cash flow positive in 27, and then 28 is going to be great. Now they're going to have to go back and ask for more money in 26, more money in 27. 28 is going to be okay. Everybody's going to be really happy in 29. That is so far off in the future that it's not what you want to share with your investors. So in this case, I would reject that proposal, and I would find a way to get us back on track. So the other thing to note, though, is that does bring down our cash at closing is $690 million. So under some circumstance, somebody might want to look at that, but that shouldn't be the driving consideration for a team that's focused on delivering a successful transaction. That happens. The successful transaction happens after you transition and operate and bring the asset in-house. It doesn't happen at closing. So again, now we're asking people to ask for a lot more money for a much longer time. Doesn't have a huge impact on our reserves. Has a pretty significant impact on our net present value, but it doesn't have much of an impact at all on reserves. And so if we were just tracking that, we may not recognize what a sensitive issue this is. So let's do some wrap up now. We've looked at these different sensitivities. So the point to take away is that we can have these unexpected results from time dependencies. So it's important to ensure that your key metrics, in this case your story and your value and needs over time, and your review process are going to catch all these temporal issues. A robust model can handle those time sensitivities. If you model things accurately but inappropriately, then sensitivity runs in various scenarios are going to break your model, and you may assume that you're in good shape when you're not. You should always include the right expertise. In this scenario, without a thorough review of those contracts and a very detailed understanding of how they're applied, it would be quite difficult to notice and accurately model this scenario. And the ability to communicate with and support other disciplines is incredibly valuable. So none of us works in a vacuum, and all of these temporal issues, as they get more and more complex, it requires more and more expertise to understand and model and correct them, and that requires people with some multidisciplinary experience and a curious mind, and not necessarily people with very deep specializations. Even though you can integrate and involve those folks, you just want to make sure that somebody is managing the project who understands the various roles. So thank you for your time. I'm sure you're tired of my voice at this point. It's been a lot of fun, and feel free to reach out to me. I'm going to do the Q&A here in a minute, and always happy to answer questions if they come up. You can find me on LinkedIn.